For decades, pizza has been the ultimate American comfort food. Come rain, snow, or an economic downturn, a large pepperoni was the one meal people could reliably fit into their budgets. But behind the counter, the math is starting to break. Right now, national corporate pizza chains are aggressively opening new locations across the country, yet the local franchise operators actually running these restaurants are quietly going broke. In Oregon, Rogue Fare LLC, a company operating 5 Mountain Mike's locations, has filed for Chapter 11 bankruptcy. The court filings reveal a massive financial imbalance. The operator listed its total assets at roughly $50,000, its estimated liabilities between $1 and $10 million. This specific filing highlights a growing tension, a local operator drowning within a system that appears to be thriving on paper, exposing a discrepancy between corporate growth and the reality on the ground. As a corporate entity, Mountain Mike's is thriving. The brand recently surpassed 300 locations nationwide and continues pushing into new state markets like Florida and Texas. That growth highlights how the franchise system functions. The corporate parent collects royalties and franchise fees from every new opening, while the local operator takes on the risk of securing real estate, hiring staff, and paying the daily bills. Rogue Fare's creditor list spans commercial banks, the Small Business Administration, delivery processors, and food distributors. The millions owed are tied to the basic, everyday costs of running a pizza restaurant. A parent company can report record system-wide sales, while an individual franchisee sinks under the weight of local debt and operating expenses. To see how a 5-store operation ends up millions of dollars underwater, we have to look at the macroeconomic pressures currently compressing the entire U.S. restaurant industry.
This chart shows the average price of a pizza in the United States over the last 5 years. It illustrates a 15% surge, pushing the typical order to $17.61. But that higher price tag isn't translating into wealth for operators. Below that $17 price ceiling, the costs for cheese, flour, employee wages, and commercial rent are expanding, eating directly into the profit margin. Third-party delivery platforms extract their own cut. Every order processed through an app takes a steep percentage right off the top, leaving the restaurant with a vanishingly small return. Consumers are hitting their limit. Industry research indicates over a third of customers are now ordering pizza less frequently because menu prices have simply gotten too high. This creates an impossible math problem. Operating costs force owners to raise prices, but those higher prices drive away the order volume they need to pay off their fixed monthly business loans. The largest national pizza chains see these numbers, and they are already executing defensive maneuvers. Pizza Hut recently implemented a strategy called Hut Forward. As part of that plan, the company closed roughly 250 underperforming U.S. locations to protect its overall system profitability. Papa John's is executing a similar retreat, closing hundreds of stores and shifting its model to offload operational risk away from headquarters and onto franchised locations. Between these two major brands alone, we are looking at nearly 1,000 combined restaurant closures within a roughly 2-year window. Other massive systems are feeling the strain. Independent operators attached to Domino's have also recently filed for bankruptcy, carrying multi-million-dollar debts of their own. Corporate entities survive industry downturns by severing their weakest locations.
The resulting financial impact falls directly onto the local operators who signed the leases and took out the loans. When a local operator collapses under that debt, they often turn to Chapter 11 bankruptcy. This is a legal process designed to reorganize financial liabilities while keeping the doors open and the kitchen running. For consumers in Southern Oregon, those 5 Mountain Mike's locations will likely keep serving food. The severe financial restructuring happens entirely out of public view. In court, lawyers will attempt to renegotiate the operator's debts. If that fails, the restaurants may be sold off to a larger, better capitalized franchise group. The bankruptcy court protects the physical restaurant and maintains the corporate brand's footprint in the neighborhood. Often, the only thing wiped out is the equity of the original franchise owner. The restaurant industry is adjusting to a strict new economic ceiling. Operating costs have outpaced what average households are willing to spend on convenience. For decades, pizza built its cultural dominance on being a high-volume, working-class meal that cost as little as 25 cents a slice. That era of cheap, accessible fast food is ending,
As brands like Mountain Mike's continue to open new stores, the question is whether their national growth can outrun these local economic headwinds, or if more franchisees will inevitably hit the same debt wall. Americans still want to order pizza, but the economic engine that delivers it is straining. Moving forward, only the most efficient operators will survive.